The 5 credit cards I'm applying for next, and why. Before diving in, you may see a few ads. Thank you for letting them play, so I can keep bringing you free, actionable advice. Now let's continue. Most people approach credit card applications the way they approach impulse purchases, reacting to a sign-up bonus, chasing points, and never once considering the structural role that card plays in their broader capital architecture. If that sounds familiar, this video is going to fundamentally change how you think about credit instruments. Today, I'm walking you through the exact 5 cards I am personally applying for next, the institutional logic behind every single one of them, and the specific financial profiles each card is designed to serve. By the end of this video, you will understand how to construct a card portfolio that functions as a capital efficiency engine, not a rewards gimmick. You will know how to use float periods, transfer partner ecosystems, and entity separation to reduce your effective cost of capital. And you will see precisely how sophisticated operators, the kind paying private advisory firms $5,000 or more per engagement, think about plastic in the context of tax timing, liability architecture, and EBITDA optimization. Grab something to write with, because this is the framework that typically sits behind a retainer, and I'm walking through it for free. The strategic card stack framework is what separates a reactive consumer from an institutional thinker. It starts with a simple premise. No single card should serve all functions, just as no single asset class should represent your entire portfolio. Each card in your stack must have a defined role, whether that is capturing cash flow liquidity, manufacturing transfer partner optionality, separating entity liabilities, or reducing the effective cost basis on operating expenses. With that principle firmly established, let us move to card number 1. The first card I am applying for is the Amex Business Platinum card. And when I refer to the Amex Business Platinum Entity Float strategy, I am pointing at a mechanism that most small to mid-sized business owners are completely unaware of. The Amex Business Platinum is a charge card, not a revolving credit card, which means it carries no preset spending limit and must be paid in full each billing cycle. That architecture is not a constraint, it is a feature. For S-Corp and LLC owners who move substantial operating expenses through their entities, this card creates an invoice-to-payment float window that, when managed with precision, allows you to deploy that capital elsewhere for up to 55 days interest-free before the statement is due. Think about what that means in practical terms. If your entity pushes $150,000 per month in deductible operating expenses through this card, you are effectively holding a $150,000 interest-free bridge instrument every single month. That float, reinvested into short-duration instruments or used to pay down higher-cost liabilities, generates a real, calculable economic return, one that compounds annually. This is cost of capital analysis applied to everyday business operations, not theoretical finance. The card also carries a 1.5x multiplier on purchases over $5,000 per transaction, which directly rewards the kind of large capital deployments that characterize established businesses: equipment purchases, media buys, professional service retainers. The 5x multiplier on flights booked directly with airlines makes it particularly compelling for executives who regard lounge access and premium cabin availability not as luxury, but as productivity infrastructure for international operations. Consult your qualified tax professional regarding the deductibility of annual fees and business-related travel expenses under current IRS rules. Card number 2 is the Chase Sapphire Reserve, and what makes this card strategically irreplaceable is precisely what I call Chase Sapphire Reserve Transfer Partner Liquidity. The ultimate rewards ecosystem is not a rewards program. It is a multi-currency conversion platform with 11 airline and 3 hotel transfer partners, each of which carries a different redemption ceiling. When you understand point valuation methodology the way institutional analysts do, you recognize that the floor value of one ultimate reward point is 1.5 cents through the Chase Travel Portal. But the ceiling, accessed through transfer partner arbitrage into premium cabin redemptions, can approach 3 to 5 cents per point in many documented cases. For retirees and executives who travel internationally, this transfer optionality functions as a hedge against premium cabin inflation. Rather than paying $8,000 to $12,000 for a business class seat to London or Tokyo, a disciplined accumulator who routes dining, travel, and direct hotel expenditures through this card is building a liquid alternative currency that can be deployed against those exact expenditure categories. The 3x on dining and travel accumulation creates a natural alignment with the spending patterns of our target demographic: business meals, client entertainment, and operational travel. There is also a credit utilization consideration worth discussing. The Sapphire Reserve carries a high credit limit for qualified applicants, which, when managed with low utilization, contributes positively to the overall utilization ratio architecture of your credit profile. This matters enormously for future borrowing capacity. Whether you are refinancing investment property, accessing a business line of credit, or qualifying for a jumbo mortgage. The third card is the Capital One Venture X Business, and the Capital One Venture X capital efficiency model is built on a principle that sophisticated operators deeply appreciate: simplicity at scale. The Venture X Business earns an uncapped 2x miles on all purchases, with higher category multipliers on specific spend buckets. For business owners who have diversified, unpredictable expense categories, consulting fees, software infrastructure, freight, contractor payments, the flat rate accumulation eliminates the cognitive and administrative overhead of routing each purchase to a category-specific card. In capital efficiency terms, a predictable 2x accumulation that is redeemable against any travel purchase, or transferable to 15-plus airline and hotel partners, represents a consistent cost basis reduction across your entire operating expense ledger. If your entity spends $500,000 annually through a 2x flat rate vehicle, you are generating 1 million miles, which, conservatively valued at 1.5 cents, represents $15,000 in annual cost basis reduction against travel and operational expenditures. That is a yield on operating expenses that most business owners are not currently capturing. There is also a liability architecture dimension here worth acknowledging. The Venture X Business is a business card which maintains the liability separation between personal and entity credit profiles that any properly structured LLC or S-Corp should enforce. Commingling personal and business credit instruments is not simply an accounting problem. It is a liability exposure problem, and the IRS maintains clear substantiation requirements for business expense deductibility. Using dedicated business credit instruments is part of the institutional framework that protects both entity status and tax positioning. Before we move to Card 4, I want to pause on a concept that threads through the entire strategic card stack: tax timing and float optimization. In tax timing and float optimization, the goal is simple: slow the outflow of cash while accelerating the capture of deductible expenses. Because credit card statement closing dates create a reporting lag, expenses incurred in late December, booked to a card with a January closing date may post to the following tax year. This is a legal, well-established cash accounting timing mechanism. It is not aggressive, it is precise. Consult a qualified CPA to understand how your specific entity structure and accounting method affects this strategy. Card number 4 is the Chase Inc. Business Preferred, and the strategic opportunity here is what I refer to as Chase Inc. Business Preferred Ad Spend Arbitrage. This card earns 3x Ultimate Rewards points on the first $150,000 spent annually in combined categories that include advertising purchases made with social media platforms and search engines, shipping, travel, and select telecommunications. For any business owner running digital advertising at scale, Meta, Google, LinkedIn, this card is the single highest returning instrument for that specific expense category within the entire Chase ecosystem. A business deploying $10,000 per month in digital advertising through this card earns 30,000 Ultimate Rewards points monthly on that category alone. At 1.5 cents floor value through the travel portal, that represents $450 per month, or $5,400 annually, in cost basis reduction against a single expense line. At transfer partner ceiling valuations, that number can be meaningfully higher. The Inc. Business Preferred also feeds directly into the same Ultimate Rewards pool as the Sapphire Reserve, which means accumulation across both cards consolidates into a single point currency, expanding your redemption optionality without fragmenting your loyalty balances across multiple disconnected programs. That consolidation is a key principle of the institutional card stack. Unified currency pools create superior optionality and reduce the dead value of stranded points. The utilization ratio architecture principle comes into sharp focus with business cards because in many cases, business card balances do not appear on personal credit reports, depending on the issuer. The Chase Inc. Business Preferred historically does not report to personal bureaus for on-time accounts, which means high utilization in any given month does not compress your personal FICO score. For business owners who need to maintain a pristine personal credit profile, for upcoming real estate transactions, SBA loan applications, or personal liability purposes, this structural separation is not incidental. It is a deliberate architectural feature of the institutional card stack. The fifth and final card I am applying for is the Citi Strata Premier card, and the Citi Strata Premier portfolio diversification rationale is entirely about sovereign risk across point ecosystems. Here is a concept that every institutional credit strategist understands, and most consumers ignore entirely. All of your points living inside a single bank's loyalty program represents concentration risk. If Chase devalues Ultimate Rewards, or Amex restructures membership rewards transfer ratios, a mono-ecosystem accumulator absorbs that devaluation with zero hedge. The Citi Strata Premier earns 3x thank you points on hotels, air travel, restaurants, supermarkets, and gas stations. The thank you points ecosystem transfers to a distinct set of airline partners, including Turkish Airlines Miles and Smiles, which historically offers some of the most compelling Star Alliance redemption values in the market, with minimal overlap against the Chase and Amex transfer partner rosters. By adding the Citi Strata Premier as the fifth instrument in this stack, the card portfolio now spans 3 independent point currencies, each with access to different airline alliances and hotel ecosystems. That is portfolio diversification applied to loyalty currency. The same principle of non-correlated asset allocation that governs institutional investment strategy applied to the capital efficiency of everyday spending. The redemption optionality matrix is the framework that governs how you deploy accumulated points across multiple currencies. The goal is never to maximize accumulation for its own sake. It is to maintain maximum flexibility, the ability to access premium cabin inventory, hotel suite categories, or travel cash equivalents across the broadest possible set of scenarios. A diversified 3-ecosystem stack accomplishes precisely that. Throughout this entire card selection process, the liability separation protocol has been a constant undercurrent. Business cards protect entity status. Charge card structures enforce payment discipline. High credit limits with low utilization protect personal credit scores. Each mechanical decision in this stack has a downstream effect on borrowing capacity, tax positioning, and entity integrity. This is what institutional advisors mean when they talk about viewing credit as a strategic liquidity tool, not a consumer product. Before we end, let me summarize the critical insights from this entire analysis. First, the Amex Business Platinum delivers entity float strategy that, for businesses with significant operating expenses, functions as a monthly interest-free bridge instrument. One that, when properly deployed, reduces your effective cost of capital in a measurable and repeatable way. Second, the Chase Sapphire Reserve provides transfer partner liquidity across a deep ecosystem of 11 airline partners, allowing sophisticated accumulators to access premium cabin travel at effective cost bases that would be otherwise inaccessible through direct cash payment. Third, the Capital One Venture X business applies a capital efficiency model that eliminates category complexity, delivers consistent 2x accumulation on all spend, and maintains liability separation between personal and business credit profiles. Fourth, the Chase Inc. business preferred enables ad spend arbitrage for digitally active businesses, generating 3x accumulation on advertising and select business categories, with the added structural benefit that business card balances typically do not compress personal FICO scores. Fifth, the Citi Strata Premier completes the portfolio by introducing a third independent point currency with distinct airline transfer partners, directly addressing the concentration risk that undermines mono-ecosystem accumulators. And the overarching verdict: the total annual fee load across this 5-card stack is well within the threshold that any business owner with $250,000 or more in annual operating expenses should regard as standard operating cost, because the cost basis reduction, float optimization, and point currency diversification this stack delivers vastly exceeds that fee and economic return. The institutional card stack is not a lifestyle product. It is a capital efficiency engine, and the 5 cards in this stack are each a component of that engine, selected for a specific mechanical purpose within a coherent strategic framework. If this level of analysis is what you have been looking for, please subscribe for more free institutional-grade analysis and credit card strategy that you will not find anywhere else on YouTube. Please click the thumbs up button to like this video if it has provided value, and comment below with your questions or content requests. I read everyone. Disclaimer: I am not your financial advisor. This content is for educational purposes only. Consult with qualified professionals before making any financial decisions.